I think we need to be careful about trying to say it's a me or them or him or us type of thing. It's better or worse. It's neither. You can have both. Both perform a role in the portfolio. So let's look at a sort of fairly easy example of this is if I hold Australian listed debt, hybrids essentially, they have very particular characteristics, they're floating rate. And let's say I choose to say I don't want to use a manager for my bond and credit. Maybe I'll just buy the index because it's very bond-like, government bond-like. I'll just use the index as a way to buffer that, and I can be quite flexible in using that index. If I know what I'm doing, I can buy and sell that index at any time. It's listed in the market. I don't take any manager risk. I know what the duration is of that portfolio. I know how it should react in certain times. That might make sense, but you've got to know what you're doing to do it. If, for example, I hold a global, highly concentrated portfolio, let's say my global portfolio has 40 stocks or less in it, I would argue it makes sense to hold, let's just use a simple MSCI World passive index as well, because that manager cannot possibly outperform all the time. You're hoping it'll outperform over a 5 or 7 year cycle. With that amount of stocks in it, it's just inconceivable. All those stocks will always be outperforming, and you may not enjoy the volatility of that ride and the possibility that the manager has misread the circumstances that it's heading to. So why not have that buffer? So sometimes it can make sense. If I am just trying to express a tactical view, I think the dollar's going to move, I may just use it to express that view at that particular point in time. You see, that's the most common one that's used globally, is for big investment houses to use it to express relatively short-term views, let's say less than 12-month view in and out of some of the sectors. It may be if I'm uncomfortable with the manager that I'm using at the moment, the active manager, but I don't want to be out of markets, I will just use passive to be there until I've made a decision. So I don't hang around in a manager I don't like, I just go passive and then I go back into an active manager when I find one that suits me. So there's a whole host of reasons to use it. In my opinion, the least good reason, if you like, is cost. Cost is a benefit in passive, but it shouldn't be the predominant driver. It might be number 7 or 8 on the pecking order for one. It's really important to understand what you're buying in either circumstances. If you're buying passive, are you just buying a straightforward recognized index, MSCI All Country, MSCI World, well-known bond indices, or am I buying a fund that says it's an exchange traded fund, but it's actually not passive. It's making active decisions about the weighting of companies. Equal weighted is not a passive approach. It's an active approach about saying I'm going to equally weight all companies as though they have the same merit and that the market's valuation of a company in terms of market cap is wrong. So it's an active decision. And once I go down that path, I'm not saying it's a bad strategy, but once you go down that path, what benchmark are you going to use to say that that person who's giving you that ETF is actually doing a good job or not? Particularly when you get down to some of the esoteric ones, do you really know and understand whether that's been a good decision, why it is a good decision, and is that person or that organization that's providing you that ETF actually doing a good job at what they're doing? And there's quite big differences. I'll give one final example. Take emerging markets. As I said before, my favorite kind of market at the moment is if you buy the MSCI emerging markets, and you can conversely buy an index based on the FTSE emerging markets. They actually give you a completely different experience. One includes Korea, one doesn't include Korea. One's got a lot more stocks. The FTSE index doesn't include Korea, it's got a lot more stocks compared to the MSCI. It's not a value judgment, but they have had quite different performances over the last few years because Korea is quite important and the diversity of stocks matters. So you really need to understand why you would differentiate between those two and what portfolio it might suit. So it's not as simple as just going, I'll go passive, I'll go active. Give some thought as to what you're trying to do, the reasons why, and appreciate what is actually in each of these strategies.